Good day everybody, my name is Victor Schaefer and today I would like to talk about some special mortgage options. It's getting more and more expensive for people to buy a house. Because of inflation, the real estate price goes up like crazy. The rates will probably go up as well because of inflation, and less clients are able to purchase a home. Today I would like to talk about 3 mortgage options which many people do not know about it. 2 of them are specifically designed for self-employed clients which don't show high income. Many of the self-employed clients don't show high income. And one option which is good for every person who maybe has problem to save the 5% for the down payment. Let's go straight into that without wasting any time. But before I will talk about the mortgage options, I just want to make sure that every person understands that my goal is not to get you in a house which you cannot afford. This is not the goal of this particular presentation. It's just that many clients think they cannot afford to get a house because the bank said no. They know they can pay for it, they have the money, but the bank said no. And they're under the impression that there's no options for them. But with this presentation, I would like to show that there is option available. But just make sure that if you purchase a house and we will help you to get the mortgage, finally you will need to pay for it. It's your responsibility. And if you will not pay for the mortgage, the bank will take the house away. I mean, that's how it is. And the other disadvantage is if you buy a house which is not really suitable for you, and maybe it's too expensive, you're not going to enjoy it, because every month there will be high payments and there could be tensions. Could be tension in the family and relationship, but can finally go even up to divorce. So my recommendation is be careful, be reasonable. You're the only person who knows if you can or cannot afford the payments. So make sure you run your numbers and we will help you to get the mortgage, but you need to do your homework and make sure that you're able to do the payments for the mortgage you will get from us. If we get many times phone calls specifically from self-employed individual, and they're telling us that, give us how much do I qualify? It's very, very difficult, pretty much impossible to say how much a person qualifies until we see the paperwork. Because with today's days, we're not paying just attention to credit. We pay attention to everything. We pay attention to income, to credit history, what this person is purchasing. Specifically self-employed, we look at 2 years history and we look at net income, gross income. There's so many numbers. But the easy answer is, or the rule of thumb that I usually use, I say that 25,000 income gives you $100,000 mortgage. So if you make $100,000 a year, you will get $400,000 mortgage. And if we're talking about income, I'm talking about gross income for employees, salaried employees, and I'm talking about net income with self-employed clients. So, I mean, 100,000 net income for self-employed people, that's not what you see every day, but those are the rules. And if we're talking about income, we include everything in income. We include your rental income, we include your any income like child tax income, any income you can get, we include, and then at least person has a little bit an idea, how much he qualifies based on his or her income. Okay, let's talk about options. The first option I would like to present is for someone who is self-employed and maybe for many, many years, and he has good gross income, but doesn't really show net income. In this particular case, $140,000 gross, $20,000 net. So you need to understand that if the lender looks at your application, they don't pay attention to gross, they're looking at your net income because you're self-employed. And you make less than a person who works for Tim Hortons or McDonald's. So you don't really qualify for any mortgage. And now we have those non-traditional lenders. And the good news is that those non-traditional lenders are getting more and more aggressive. Why? Because they're getting good quality clients. I have so many conversations where the client tells me, I don't understand. I always got a mortgage from my bank. Now the bank tells me I don't qualify. I'm still the same person. I still pay all my bills on time. My credit is good. Yeah, the income is the issue. The real estate price goes up, the issue, and the interest rate will go up. Or already we call it stress test rate. We have to qualify you based on higher rate than you will really pay. So all those factors are definitely affecting you negative, and that's why the lender says no. But the good news is now we have lenders who are fighting for those type of clients, and they're really aggressive. They're not, in the past, if we went on the B side, the rates were very expensive and they were very high fee. Now those B lenders, they're very close to traditional lenders. And lots of my clients actually like those options and they're jumping on it without any delay. So how they do the calculations? they use a different income structure. What they do, they just ask us for last 6 months account statement from the client, and we look how much money was deposited, and we just average, let's say in the last 6 months the person got $60,000 deposited on the account. Because we use annual income and it was only 6 months, we multiply by 2, so now we have an annual income of $120,000. And the lender allows us to use this income with a small deduction, because finally they say, we don't want to use the full amount because the person still has expenses, right? So usually we use 80% of this calculated income that you see, in this case $120,000, to determine the qualification income. In this particular case, we can use $90,000. So you see it's a big difference between 20 and 90. Now at least the bank will talk to you, not on the A side, but on the B side, because they will use $90,000 to qualify you. Now, I always like to show advantages and disadvantages of any option. So advantage of this option is that you don't need to wait, because the other option for us as a brokers is to tell the client that now you have to show 2 years high income, because if you don't show high income, we will not be able to help you. And the client is asking like, what do you mean with high? Yeah, $90,000 a year, let's say in this example. And then they understand what it means. That means that they will pay a lot of taxes. Now they have to show 2 years, $90,000 each year. There will be lots of taxes to be paid. Plus I have to wait for 2 years, and within the next 2 years, who knows what will happen with real estate price. The clients don't really like it. And that's the advantage of the B lenders. You don't need to wait, because you can go and get this option right away. The downside, yes, you get a little bit higher interest rate, because the lender finally is taking a little bit higher risk, right, compared to traditional. But it's not a lot higher. Like really, in the past it was like 2-3% higher. Now very close to traditional mortgage rates. Let's say a 5-year rate, just give you an example, would be 2%. And then in this case, for 5 years, then in this case you get maybe 2% or 2.1 for 1 year term. So because we always like to move the client 1 year or 2 years later to the traditional side, but many of our self-employed clients don't qualify for traditional in year 2 and year 3 and year 4, because they don't want to qualify, because they have to show 2 years income, and that's a lot of money. And just to show you guys, just to give you a little bit an idea what it means to pay to show income for 2 years. In this particular case, let's say we have to show $80,000. Now the person has to make net, not gross, net, $80,000. So let's say we will take Manitoba as a province. He will pay $20,000 on taxes. Okay, so he has to pay, show you $80,000 income, pay $20,000. That's a lot of money that he has to wait 2 years, and he has to pay every year $20,000 on taxes, because now he shows $8,000 income. And because the person is self-employed, they still have to do deductions on top of it, on top of taxes, right? You don't have to pay EI, because you cannot fire yourself, but you still have to pay CPP. And if you look at the CPP calculator, if you're self-employed, you have to pay 10.9% of your gross income. So in this case, you pay $6,300 just on CPP. So now you have to just add the $6,000. You're adding the additional $20,000. So you're $27,000 per year that you're gonna lose, because now you have to show income. So in 2 years, you'll lose a lot of money. So, and by going with this non-traditional lending, the advantage is that you don't have to do this. You will not lose over $50,000 in the next 2 years. And if you do the math and figure out how much you really lose by going this direction on rates and on one-time fee, you will see that this is literally day and night. You will maybe lose only 10% of what you would lose if you would go traditional option and show 2 years income, plus you have to wait for 2 years to qualify. On the B side, there's always a fee. The fee is one-time fee. And again, that's what I'm saying. If you do the math, how much you will pay an interest rate and then a fee, you will figure out it's a lot cheaper to go this road than the other option. The 1% fee is one time. So if you renew the mortgage with the same lender, there's no additional fee. Okay, it could be more than one. It's depends on the risk of your application, but usually it's 1% fee. The second option I would like to describe is for someone who is less than 2 years self-employed. 99% of the banks will not talk to you if you are less than 2 years, and they not just 2 years self-employed, they would like to see a 2 years tax return. So That means if somebody is just became self-employed, they have no options for the next 2 years. And the bad news is, even after the 2 years, you still probably will not qualify because you don't show any income. And this is when this option jumps in. You know, we can help those clients if they're at least 3 months self-employed. We don't care about income tax, not like the banks asking for 2 years income tax for self-employment income. No, in this case, we don't care. Just show us 3 months account statement. We want to see the deposits again, whatever it was deposited in your account. Let's say in this particular case, it's $30,000 that was deposited in the client's account. Because it's only 3 months, we multiply by 4 because we pay attention to annual income. And then again, we do a small deduction of all the expenses that your client also pays. And usually it's allowed for us to use between 70 and 80% of calculated income. So in this case, again, client can use $90,000 income, which is a lot more than zero, because the other option is to wait for 2 years and pay 2 years high taxes to qualify for more. Why would you consider this option? The same like in the previous situation. House price goes up. By buying today, you are not losing on the appreciation. You're actually making money with appreciation of the property. We don't need 2 years tax return, and even after 2 years, the most clients don't qualify. Disadvantage is you pay a little bit higher interest rate again, and you pay 1% or more fee based on the strength of your application. The last option is the cashback option. I really like this one, and especially in the lately, I see more and more clients actually like this option, because if to get a house, you need 5% down payment. And many clients are struggling because they're close to 5% of savings, and then the house price goes up, and they can just not catch up with the price increases. And they're saying to us, look, we have 4% and we're missing a little bit. So we can go to a lender which they're giving us a cashback. That means the client get literally cash as a gift, not really a gift. I'll explain how it works, but at least it looks like the lender is giving you money back, and you could use the money for whatever you want. So when do we use this option? If the client cannot come up with 5%, or he can come up, but the parents are willing to help him out, but he wants to repay the parents for the money that they gave him. After you get your key, the lawyer will receive the funds, and he will give you let's say it's $300,000 mortgage, and you got 3% cash back. The lawyer will give you the $9,000, and you can do whatever you want with it. The other option is that client wants to buy this house, but he has an unpaid credit card or a car loan, and he needs to pay off, but he doesn't have the funds. We're using those funds to pay off those debts so that the client will be able to qualify for the mortgage. Or just give you one more example, the client has 5% down payment, but he doesn't have legal cost coverage, and it depends which province you are. It could be 1%, could be 2% of the purchase price, so you could use those funds to pay for the legal cost coverage. Or you used all your funds for the down payment and for the legal costs, and you have nothing. You cannot buy appliances, you cannot buy furniture. The lender gives you the funds, and you can buy appliances or furniture with that, because again, lender doesn't care what you're going to use the money for. They're just giving it to you. Nothing is free in this world, right? Especially with banks. I mean, they want to get the money back somehow. And what they do, they actually increase your interest rate by so much that they will be able to get the 5% back within the next 5 years, or in this particular case, 3% cash back, okay? So just give you an example. They gave you $7,000. They will increase your interest rate, and if you do the math, if you use a calculator to figure out how much money you lost because they increased your interest rate, you lost about $9,000. So they gave you 7, you lost 9, so you really lost only $2,000 because the other 7 you benefited from, you bought something for it, right? So the cashback option is not bad. I actually like it. Again, if you don't need it, let's say you have the 5% and you have legal costs and you don't need cashback, don't take it. Why would you lose $2,000 in the next 5 years just by taking it? So, but if you're struggling or you need the money, yeah, definitely a good help. The other thing what I think is very important to mention, if you decide to break your mortgage within 5 years, okay? Breaking the mortgage is always expensive, right? And it depends which bank you are with. I'm proud of it that 99% of the mortgages my team does, we always do with low penalty lenders. That means if you decide to break the mortgage, you pay a really small penalty. But if you get your mortgage TD, Scotia, RBC, with all those guys, it's very expensive to get out. So any options we give you, it's always low penalty lender. But if you get a cashback option, and you, let's say it's a 5-year term and you break it in year 3, yes, you still will pay penalty, but just a little bit because it's a low penalty lender. But the bank also didn't get the money back yet, right? Because they would get their cashback back within 5 years, but now you're breaking the mortgage and they didn't get the money back. So what in this case will happen? They will charge on top of penalty whatever prorated cashback amount they will charge on top, and you have to repay it before they will release you from the mortgage. Okay, so it's nothing wrong with it, it's fair, but just want to make sure that clients are aware about that, because this is an important factor. It's not like a gifted money. Okay, if it's 5 years, after 5 years, yeah, everything is back to normal, you are now a traditional client, but within 5 years you have to repay the cashback back. And there's no fee on this one because it's a traditional mortgage, it's not on the B side. Okay, that's it, pretty much everything. So if you have any questions, by all means, send us an email, give us a call. I will be more than happy if you will, like and share this video, and maybe share it with your friends, especially some of your self-employed clients who think they will never qualify for the mortgage, or for some younger people maybe who cannot really save the 5% for the down payment. So there are options available. You just need to be aware about them, and we will help you out with any of your mortgage or insurance or investments needs. That's it for today, and I guess until next time in the virtual world.